Well, hi there, and thanks for joining us for our Investment Review Committee Equity Growth Share Class Update for April 2018. As always, this is Jason Ayers here, and I have Alex Brandolini, our lead portfolio manager for the Equity Growth Pool. Alex, how are you today?
I'm well, Jason. Thanks very much. How are you?
I'm doing well, thanks. So as always, I know you've got some real interesting observations and some details on just some of the things that we're looking at presently based on current market conditions. I'm excited to have you explain some of these charts that you've integrated in the presentation.
All right, cool. Thanks a lot, Jason. So there's really three things that I want to do here today. I just want to talk a little bit about where we are with respect to markets and what to expect. I also want to touch on what sectors within the market are expected to do well based on our current environment. And lastly, I want to drill a little bit deeper and I want to explore what factors are going to do well in the current environment and why the rotation into defensive stocks is probably not a good idea right now. So to begin with, I just want to talk a little bit about where we are economically and with markets. What we have in front of us here is the Bloomberg Intelligence regime detection model, and that's a research division of Bloomberg. I have to give them credit. It's a pretty amazing model that they've developed. It's based on 27 years of history, and it uses a very large number of variables to characterize different periods based on two things, and those are economic fundamentals and market conditions. So as we see on the page here. Right now, the economic fundamentals are indicating that we are still in the middle of an expansion that's consistent with everything that we've been discussing, everything that we're seeing. But the model also has changed recently, and what it has demonstrated is that there was a shift in market dynamics in the month of February. And what we did in February is we entered a late cycle regime. So when you take those two factors together and you look at them in combination, what's typical of this combination are higher equity prices. So we do expect equity prices to increase. However, we are expecting lower average monthly returns. So while prices are going to go up, they're just not going to go up at the same rate that they used to. We are entering that late stage, so there isn't that big drive behind markets, kind of like what we've seen in the last few years. What this combination also demonstrates is that there are periods of volatility spikes, and there are cyclical sectors that will outperform. So I'll get to all of that in a moment. But as well with this, with the current economic regime that we're in the current period, it is very analogous to what we saw in 2005. There was a very similar combination of scores in 2005 in relation to what we're seeing right now. And qualitatively speaking, in 2005, that's where the Fed was also tightening, kind of like they are now. Inflation was also rising, kind of like it is now. Global GDP was robust, kind of like it is now. And valuation ratios had peaked and started flattening, a lot like what's going on now. What I also want to note is that this model exited the late stage cycle in about 2007, which was roughly 2 years, probably a little bit more than 2 years after its entry into the late cycle. This is also consistent with everything that we've been discussing up until now, where the mature phase of the macroeconomic cycle is expected to last 2 to 3 years. And I think we started talking about that a few months ago. So it's very good to see multiple unrelated sources of information and intelligence agreeing with each other. And what we try to do always is look at things from multiple perspectives and check for agreement between our theories. It lends a little bit more credibility to our view, and it makes us a little bit more comfortable with how we're looking at things. All right, so what do we take from all of this? That's kind of like the regime we're in. We've entered a new regime. What do we do about it? Like what do we look at to take advantage of things? Well, if we look at the sectors that have done well in different periods, So we've got the consolidation period, we've got the early cycle period, and we've got the late cycle period, which is boxed in green for our viewers. What we see is that the top three cyclicals, technology, financials, and energy, did the best. So the returns there are all higher than the S&P 500. That return is listed on the very first line under late cycle. Under return is 0.9%. Technology was 1.3, financials 1.2, and energy was 1.1. Admittedly, if you look a little bit further to the right of that, all of those sector returns were achieved on higher volatility. But let's contrast the cyclicals with the defensives. So what we can see is that telecoms, real estate, and utilities also did the worst. And what's even worse about that is that all of those sectors were on higher volatility as well. So you definitely were not rewarded in past late cycles if you were an investor in these sectors, because you got less return for more risk. So I'm foreshadowing a little bit here, but both of these observations are very consistent with what we're doing in the equity pool, but I will get more into that a little bit later. All right, so contrary to what we just saw, one observation that we've seen that's kind of interesting is that because of what was sparked with higher volatility, we've seen a lot of investors rotating into defensive stocks. But just a moment ago, we saw the regime model indicated that defensive stocks are just not a good idea right now. So if there are investors out there that are thinking of defensive stocks, I would recommend proceed with caution on adopting such a strategy. What we have here are factor returns, and in particular, what Bloomberg was able to do for us is isolate factor returns in periods of rising volatility, a lot like what we're looking at right now. What this chart illustrates is that the profitability factor has performed the best in this type of environment, and it also illustrates that the leverage factor and the volatility factors have performed the worst. Now, just a little bit more transparency there. By leverage, what I'm saying is companies that use a lot of borrowing to fund operations. They have leveraged balance sheets, and sometimes these leveraged balance sheets can become unhealthy balance sheets. By volatility, I specifically mean earnings volatility. There are companies out there that when they get quarterly net income or annual net income, it is very stable from year to year. It's got a nice, smooth upward slope. The company is growing at a nice pace. There are other companies where things are very lumpy. One quarter earnings are going to be very high. Another quarter they're going to be very low or negative. That is called earnings volatility. And in this type of environment, investors don't really like that kind of performance. So if volatility continues to rise, what we would expect is or at least what factor returns would lead us to believe, is that the market will disfavor leverage and earnings volatility, but favor the profitability factor. And by factor, if it's a bit confusing language, I would say you can think of factors as characteristics that drive a result. So, for example, one could say football teams with good quarterbacks win more games. Well, good quarterback in that sentence is the factor. So profitability would be the factor that are driving market returns in a portfolio on the positive side, and it would drag if companies were highly exposed to leverage and earnings volatility. All right, so I want to specifically focus on the leverage factor here. I want to dig a little bit deeper into leverage. And what I've got here is a chart that shows the amount of leverage in 4 defensive sectors. So that's real estate, utilities, telecom, and consumer staples. These companies have the highest debt ratios because all of these lines represent ratios to the S&P 500. So they've all got more debt than your average company on the S&P 500. And what you can also see is that this chart goes from 2003 to 2018. And in all cases, not only are they higher than the index with respect to debt, they are also higher relative to their own history. They're carrying more debt than ever before, and they're more leveraged than the rest of the market. What I want to point out here is that this will be problematic in a rising rate environment. So let me talk about my next slide. What this next slide shows is that there's a high correlation between a flattening yield curve and leverage factor returns. So when we take the leverage factor and construct a portfolio out of it, and we measure the returns out of that hypothetical portfolio, we see that as the yield curve flattens, the leverage portfolio returns become negative. They go down. And I know flattening might be a little bit confusing out there. So all I'm saying by flattening is that short-term interest rates are getting higher, whereas long-term rates are staying the same or getting lower. The point is, short-term interest rates where companies borrow are going higher. So there's a high correlation between negative performance of leveraged type of companies and rising rates. So with all of that, let's talk about how we're applying it to the equity pool. I'll begin with talking about 1 month return. So the month of March was a month of continued volatility. Admittedly, we didn't do as well as the index, but in the bigger picture, year to date, if you look at the left-hand side of your screen, the equity pool is fairly flat, whereas our benchmark is down about 4.5%. So I would say that is outperformance of the benchmark, and that speaks to the kind of things that we're doing to manage the risk in the pool and to try to enhance return in different ways, so we can keep our heads above water and do it in such a way where an investor would experience less volatility. So far it's going well. A few highlights that are consistent with everything that I've just discussed. Within the equity pool, we have no real estate exposure, we have no telecom exposure, and we have no utility exposure. All three of those sectors are exposed to higher interest rates. They're not expected to be able to perform alpha. While you might be able to find a good company within the sector, the overall sector is going to be challenged. So at the moment, we're just steering clear of those. Within our technology allocation, we do maintain an overweight with technology stocks that is consistent with the regime model. And what we've been doing is, as I've said, in late cycle, the regime model indicates historically that technology stocks have done better, and they've also done better on higher volatility. I would say that's a perfect scenario for the kind of stuff that we do, because we are very active with option strategies. So we have been doing a lot of the option writing to capitalize on volatility, to provide us with a little bit of a downside hedge, and to try and enhance return by capturing that volatility and turning it into cash. The other thing that we're doing is within our energy allocation. Even though energy has been challenged in recent years, I think there was a report today that the Saudis are very close to hitting their target of $70 oil, and now they've started talking about how they've moved up that target. They want to increase it even more, and they have been successful in removing the global glut of oil. So whatever they've been doing, it's been working. Demand is strengthening, and we haven't even entered the summer driving season. So conceivably, we could see oil prices continue to rise as demand for fuel and energy also continues to rise. So with all that being said, we do still maintain exposure to energy stocks, but what we want are those energy companies that have a lower debt profile and a very high cash flow profile. Those are characteristics very consistent with the factor returns that I discussed just a moment ago. Aside from the things that I was talking about today, we've also had some good results from our currency management. So we do have exposure to U.S. stocks. We do hold U.S. cash whenever we want to hedge out that U.S. exposure, because we think that the U.S. dollar has gotten strong enough within its expected range. What we like to do is take that off the table. So we did sell U.S. dollars to buy Canadian when the U.S. dollar was strong. we're holding exposure to U.S. companies synthetically or through puts. That removes the currency volatility, and it does help us bank a little bit of profit from currency. As well, during the month of March, things were very volatile. We were engaged in writing puts on the index. We're also writing puts and engaging in synthetic positions on quality stocks. Quality stocks are characterized by high profitability, lower debt, and lower earnings variability. And when economic or market conditions get uncertain, these are the type of factors that investors seem to be attracted to. So what we've been doing has been very consistent with our own research, with research outside of here, and that's my summary on the equity pool.
Fantastic. That is some great intel, Alex, and as always, really appreciate the work you put into these sessions. And thanks everybody for joining into our presentation this month.